Tesla just reported one of the cleanest quarters in its history. Record gross margins. Free cash flow doubled. Beat on every line that matters. And yet, by the end of this video, I will show you, cell by cell, that even the most optimistic math on Earth cannot justify half of today's stock price. Not my opinion, a spreadsheet. You can copy it and break my numbers yourself. Quick note before we start. This is data analysis, not investment advice. Nothing here tells you to buy or sell anything. Let's open the books. First, let's be honest about the good news because it is real. Revenue, $22.4 billion, up 16% from a year ago. Gross margin, 21.1%. That is the strongest reading in over 2 years, up from 16.3% last year. For a company that spent 2 years cutting prices to move cars, that recovery is genuinely impressive. Free cash flow, $1.44 billion. Positive when most of Wall Street expected Tesla to burn cash this quarter. It doubled year over year. Earnings per share came in at 41 cents, up 52%, beating the consensus of 36. If you stopped reading here, you would call this a flawless quarter. Most headlines did. So why did the stock barely move? Because the market already knows what I'm about to show you. Here is the number nobody puts in the headline. 341. That is Tesla's price-to-earnings ratio. The market is paying $341 for every $1 of profit Tesla makes today. For scale, the average company on the S&P 500 trades around 25 times earnings. Tesla trades at 341. That means the market has decided that Tesla's current business, the cars, the batteries, the solar, is almost irrelevant to its $1.4 trillion price tag. The price is a bet on a future that does not exist yet. So let's do what almost nobody does. Let's actually calculate what the existing business is worth and see how big the gap really is. This is a discounted cash flow model, DCF. It answers one question. If you owned all of Tesla, how much actual cash would this business hand you over time? And what is that stream of cash worth today? It is the same basic math used on Wall Street. And every input here is public. We start with revenue. Tesla's first quarter, annualized, roughly $89.5 billion a year, straight from the SEC filing. Growth. I'm giving Tesla 10% a year, every year, for 5 years. For reference, this quarter's growth was 16% against an unusually weak quarter last year. Analyst consensus for the next few years sits around 8 to 12. 10% is fair, generous even. Free cash flow margin. Right now, Tesla converts almost none of its revenue into free cash. And we'll see why in a minute. So the model starts near zero and ramps to 8% by year 5. 8% is roughly what a world-class manufacturer achieves at maturity. Discount rate, 9.4%, based on Tesla's own market risk profile. Run it forward. Revenue climbs from $98 billion to $144 billion by year 5. Free cash flow ramps from $500 million to $11.5 billion. Add the terminal value. The business is worth beyond year 5, growing at 2.5% forever. Discount everything back to today. Add the $44.7 billion of cash Tesla is sitting on. Total equity value, $173 billion. Divide by 3.75 billion shares, and the existing business is worth about $46 per share. The stock trades at $392. Now, before anyone types a comment, no, I am not saying Tesla is worth $46. That number is only as good as my assumptions. Maybe you think 10% growth is too low. Maybe 8% margins are too conservative. Fine, let's test yours. This table runs the same model 25 times. Every row is a different growth rate, from 5% all the way up to 30% a year. Every column is a different mature cash flow margin, from 5% up to 20%. The base case we just built? $46. Okay, be more optimistic. 20% growth for 5 straight years, and margins better than almost any automaker in history. $103. Now push everything to the absolute limit. 30% revenue growth, compounding for 5 years. A 20% free cash flow margin, a level that would make Tesla one of the most cash-efficient large companies on the planet. Both assumptions. historically extreme. Together, $204. The current price is $392.83. There is no box on this table that reaches it. The most aggressive cash flow math I can construct gets you barely halfway. So the honest conclusion is not Tesla is overvalued by X%. The honest conclusion is the market is not pricing Tesla's business. It is pricing something else entirely. So what is the something else? The other half is the future. And to Tesla's credit, they are not hiding it. On the earnings call, Tesla raised its 2026 capital spending plan to over $25 billion. That is roughly 3 times what it spent last year. 6 new factories, an AI compute build-out, cybercab production, Optimus, the humanoid robot, targeted for late summer. And the CFO said the quiet part out loud. Free cash flow will be negative for the rest of the year. That strong $1.4 billion from the first quarter, management themselves told you not to expect it again in 2026. So the $1.4 trillion valuation is really 2 bets stacked on top of each other. A $200 billion bet on the car company that exists, and a $1.2 trillion bet on robotaxis and robots that in revenue terms are essentially zero today. Elon Musk himself said robotaxi revenue will not be material this year. That second bet might pay off. Genuinely. Autonomous ride-hailing could be a $1 trillion market. But you should know, with numbers, not vibes, exactly how much of your share price is standing on it. Right now, it is most of it. So here's the takeaway. Tesla's quarter was real. The margins are real. The cash pile is real. And the math is also real. Every dollar of today's price above roughly $200, even under extreme assumptions, is a payment for a future that has not arrived. Not a bad bet, necessarily, but an unpriced one. And now you know its size. The full spreadsheet is linked below. Change my assumptions. Break my model. That is the entire point of this channel. No stories, no hype, just the math in a spreadsheet you can check. If you want the next breakdown, same model, different ticker, subscribe. And one last time, because it matters. This is data analysis, not investment advice. Nothing here is a recommendation to buy or sell anything. Do your own research, preferably in a spreadsheet. See you in the next one.